This Week in Startups is brought to you by GoToMeeting. Meeting is believing. Visit gotomeeting.com. Click the Try It Free button and sign up for a 30-day trial. And InVision. Find out why so many hot startups are using InVision to prototype, present, and collaborate on design in real time. Sign up for a 90-day free trial today at envisionapp.com/twist.
That's what it's all about, man. They said money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you. Yeah. Money is the root of all evil. What? Funny how it feeds my people. Yeah. We ain't gonna live like equals until we get the money, spend the money, and defeat you.
Hey everybody, welcome to This Week in Startups. It's our news roundtable edition, and it is going to be an awesome show because when you're talking about the news, if you have people who are journalists and who do research, my God, that's a powerful combination. Today on the program, Danielle Morrill is with us again. She is the founder and CEO of Mattermark. Mattermark is a database, it's a database of all startups and actually non-startups now. You have regular companies in there and you track all kinds of interesting data about companies, correct?
Yep, absolutely.
And people pay for this. It's like, I think startups pay $500 a year and then other people pay a couple $100 a month.
Yeah, it'd be $6,000 a year.
Yeah, and you're basically the biggest nightmare that VentureSource or some of these other database companies ever had.
Yeah, we're eating their lunch.
Eating their lunch, there it is. And Danielle has a lot of good data, so we'll be talking about that in a minute. And for the first time, Katie Benner is with us. She is the New York Times reporter, and I think specifically you're on the Applebeat. Is that right?
Applebeat, but also venture capital and startups.
Perfect.
So here
it's
we are.
Great. Why haven't you been here before? How long have you been at the Times?
Since June.
Since June. Okay, so you're relatively new there. How is it? How's the great lady doing?
It's fantastic. It's great. It's fun to work there. I have good colleagues. It's nice to be in San Francisco instead of New York.
Have you met Markov yet?
Of course,
yeah,
and he
John's
is wonderful. He's responsible for why the office is so mellow and friendly.
Yes, he's a cool dude. All right, let's get right to it. The markets went absolutely... Well, they imploded, let's be frank. It's gone 10-20% in January here. And venture investing, we all know, was a little bit shaky towards the third quarter, I think, probably in the summer. All these valuations that were getting ahead of themselves seemed to pause, and things got written down. Katie, you just wrote an article in the New York Times. Venture investment declined sharply at the end of 2015. What's your take on the venture climate today?
Well, it seems like a lot of investors had been talking about, like you mentioned in the summer, they had said, okay, things are getting a little bit overvalued, things are getting overheated. And so by the fourth quarter, by the end of the year, it looks like people thought, well, why take on more risk? Why not pull back and see what's actually going on and see how things shake out with our existing companies? Right.
So a little pause. Mm-hmm. And you spoke to VCs, I'm certain, during your reporting. And what was the, color commentary from them? What was the anecdotal reasoning behind them taking this pause to invest?
Anecdotal reasons included everything from the fact that founders, they thought, had been getting a little bit too bubbly themselves, that the founders themselves, their expectations for what their company's worth were getting a little bit out of hand, and that wasn't going to work anymore. They really wanted to make it more of an investor's market rather than a founder's market.
Right.
So they pulled back to see what was going on. And that they also saw that some of their companies, and we'll talk about this later, that the unit economics weren't good. Right. And they had to sort of enforce a discipline around what people were doing in terms of spending and cost.
Got it. Danielle, what did you see in the data? Because I know that we had a whole late night tweet storm about it, because you can actually tell from the data which companies are in trouble, right? Zombie companies, whatever you want to call it. Explain how you know from the data in Mattermark, like which companies are at risk or potentially at risk, I should say.
Yeah.
Because you don't have complete data. You're not inside the company.
So there's two signs that I usually look at first that are, I think, the strongest indicators. One is just the timing between funding rounds. So if the company's gone 16 months, they haven't announced a new round, and they're not just going gangbusters, it's a concern because it usually signals that they've maybe gotten close to the end of their runway and are in trouble and struggling to raise.
Yeah.
other one is employee count. So generally these companies, as they're scaling up, they're adding employees, like net adding. Like there's a positive ramp. So if you see a company where over the past 6 months they lost like 20 or 30% of their net employee count, that can also be a really bad sign, even if they have a lot of money.
And you can just check that on LinkedIn. People put it on their LinkedIn.
So yeah, you can get that. People put where they work all over the place these days. So, on Twitter, on Facebook, on LinkedIn, on GitHub, on Hacker News, all these places we have identities. So it's becoming easier to tell how many people really work for a company, and we're tracking that.
So what do you think all this means in terms of the market and going into 2016? Or are we going to see a bunch of startups shut down? Or are we going to see a bunch of startups run more efficiently and be more stable? Katie, you want to take it?
I think that we'll probably see startups be run more efficiently. We're already starting to see people institute either a hiring freeze or cutbacks.
Yeah.
And then
Instacart did that, didn't they? I saw Instacart raise their prices.
And then we're also seeing people raise prices and trying to figure out
recruiting. Yeah.
Exactly. How do we make this company work with the money that we have? How do we make this company work with what we've got? And I don't know that we'll see companies shut down as much as we will see companies be sold.
Yeah.
And there's a really technical reason for that. And it has to do with the terms that the investors get. So for the investors, most of them are protected. When they invest money into a company, they invest money saying, whatever happens, if this company's sold, I get X amount out.
Right.
And it's probably the equivalent of what I've put in. So if that's the case, why shut the thing down if you can sell it and know that you've preserved your investment and find a buyer? This, of course, though, creates other problems because common shareholders, employees, don't have those protections, so they usually don't get very much money.
Right. And they didn't take much risk. They got paid for their time. And here in the Valley, they got paid incredible salaries. So it seems like that's...
It depends on whether or not they exercise their shares and paid a tax bill.
Yeah, that's a very risky thing to do. There was, I guess, some example of a company where employees started exercising and then the company got sold.
Right.
Was that in New York Times?
It was good technology.
Yeah.
And part of the reason why the companies were exercising is because the company was so old. So even though it was called a startup, it was venture backed. By the time it was an old startup from the 90s that reincarnated itself again in the 2000s. So by the time it got sold, there had been many, many years where employees had left and had been given a 3-month window, which is typical, to decide whether or not to exercise. But we are seeing a lot of companies now that are considered unicorns. A lot of them are 7 or 10 years old themselves.
Yeah.
Jawbone, which is an example of a company that just had a down round. Jawbone is what? They were founded in 1999.
Yeah.
That's a very old company. So it's not just good. We're going to see a lot of employees faced with that question of, well, what do I do if I leave this company? Do I keep the
Should
stock?
I execute my stock option and buy them?
Options? Exactly.
Because if you buy them, you have to pay tax.
Exactly. Or do I leave it on the table?
And the flip side is if you're really early stage and you're offering that perk, that could be awesome. But there's like a point where it's a better perk to let people exercise for 10 years. There's sort of this kind of tipping point. So obviously, Mattermark is an earlier stage company, so our stock price is really low. So if you can give people early exercise now, that's great.
Yeah, because
but they need to take advantage of it before the fair market value goes up and the difference becomes too big. And later, as you grow, a different perk is better, which is giving them all that time to make the decision. So I think maybe people just never change their plans. I don't really know why, but your article certainly made me think about what we should be doing long term as our price goes up.
People have been bringing this up for a couple of years now of like extending the exercise period, because that was something previously where you didn't want people leaving the company, quitting and taking their options.
The cap table.
Yeah, and but they did earn them, and but it was sort of this way of if somebody didn't want to pay for the shares, they lost them. You had to execute or lose them. But now people are just going to extend it for a year or give them 2 years or 5 years.
Quora has done that. I think
Quora did it,
done that. Yeah.
Yeah, I think some of the sort of quirky, longer-term companies will do that kind of stuff because Quora is being run by, I guess Adam, what's his name? Adam D'Angelo. I think he's funding it with his own money.
Wealthy guy.
Really wealthy guy. So I think he's probably taking the approach well, I want to keep these employees around. And I'm not saying Quora is a lifestyle business, but Quora is run differently than a lot of other businesses when the founder has a lot of money in it. He's taking a very long approach, like maybe a 2-decade approach.
He doesn't have a lot of investors who want their money back.
Right. I mean, it's a lot of it comes down to alignment with investors. So to go back to your question about what's going to happen, all these people who have a lot of debt need to figure out how to convert that to equity. If they want to have somebody care about what's going to happen to them, then they need to have an equity investor. And so I think one thing you're going to see is fewer seed stage companies who have convertible notes getting those converted to equity, and that's a big problem for them because then no one really has skin in the game.
Didn't you have this problem a couple years ago at Mattermark?
I mean, we had a ton of debt until we took our Series A, and it definitely, as soon as I became a little more concerned about the market a little sooner, and maybe that's because I have a lot of data, but as soon as the market started to turn, I felt like, okay, the number one priority now is to get an equity investor and to get away from debt.
You got Brad Feld.
We got Brad Feld, which is awesome. He also takes a very long view, which has been great for us.
Yeah, and you were able to you had multiple notes, right? Because when did you found Mattermark?
We, 2012, so we have like 150 individual note holders.
Wow.
So yeah, because we slogged along for a while there, just trying to survive. But yeah, converting everyone was very, very important, just in terms of how liquidity, events affect the payout order. You want to get that debt off the table.
Right. The convertible notes are great because you can raise money so quickly and so cheaply. Mm-hmm. But if they build up and the business is becoming a real business, it should be equity at some point.
So one interesting thing you're going to see too is companies that have equity backers, those backers coming back to them and saying, hey, we'll just give you a convertible note with no cap on it just to kind of extend your runway. You don't have to announce it. No one knows. And for that investor, that's great for them. That's the first thing on the list. So I think you're going to see a lot of inside rounds that don't get announced, and we don't know about them until a lot later.
Yeah, I'm actually seeing that.
Yeah.
I'm getting a lot of emails about that.
And founders are like, what's this? This is new. So now founders have to figure out how to operate in that environment.
So I'm really curious. You've mentioned that a lot of the things we've talked about around employee equity, around debt, are things that have been concerns floating around the Valley for years. Why do you think it is that even though these things have been talked about quietly for years, they haven't been absorbed, or it doesn't feel like lessons have been learned?
Well, we didn't have companies staying private as long. So that has totally changed how things operate. The fact that Facebook stayed private for so long until the SEC pushed them out the door, and then the SEC changed the rules a little bit. You could have more people on the cap table before going public. And now Uber and Airbnb, Dropbox, a lot of these companies with very significant revenue staying private for longer because it is easier to operate privately. Who wants to go out and go public and have the distraction when you can just be in private mode and keep working? So that exacerbates the problem. If you can't, people used to get liquidity easier because a company would either go public or go out of business. But now if a company stays private for 10 years and has billions of dollars in revenue or hundreds of millions of dollars in revenue, there needs to be some way to have the early investors and the early employees get liquidity. So that's where the secondary market is starting to happen. So that's the reason.
There's also a lot more debt because there are a lot more of these founders who are like me who raise a lot of debt, and there's a huge explosion at the seed stage, right? Yeah. So maybe not as many dollars, relative to the big picture. The seed piece is pretty small, but the number of people affected by it is really large. So maybe that's another reason why it's coming home to roost is people are starting to worry, okay, we're not going to convert this debt.
Also, people are more sophisticated now. When I started in the industry 20 years ago, people didn't even know what a convertible note was. They didn't know the documents. People didn't understand that there was preference. People didn't understand what preferred share was. Employees just came and they got options, and the options were considered icing. Now you have very sophisticated people. So you have people who were 25 years old and made $1 million at Google. Then they were 35 years old and they made $3 million at Facebook. And now they're deciding to go to Airbnb or Uber, and they're on their third startup, and they're coming into the discussion saying, okay, am I getting RSUs? What's my strike price? What's my window?
They ask great questions.
They've been through it 3 times. So they're like, yeah, I remember what happened. I should have, if I had executed my Google shares when I got them, I would have paid a lower tax bill. Would have been better for me. The cap gains would have kicked in early, whatever. So that people get burned, they get educated, and now we have this incredibly educated populace out there. And all the information's out there. Back in the day, 10 years ago even, nobody shared information. There were no blogs. So once I started blogging, and who else? Fred Wilson, Brad Feld, then people would start talking about, hey, convertible notes, or should convertible notes even exist? There was a moment in time where Ron Conway and Fred Wilson were like, convertible notes are terrible. If you want to be in this game, you need to do an equity round. That's how it's done. Mm-hmm. And then they were proven wrong, and equity wasn't the worst thing in the world. And they flipped their position. They started doing it. But it was a really public discussion. It was more transparency in it.
Right. I mean, I think there's still a lot of things that are confusing because everyone's looking to create information asymmetry. There's a big advantage to being on the positive side of that asymmetry. Sure. So it's almost like I mentioned these, uncapped convertible notes after an equity round. That's a new thing that puts the founder kind of in a disadvantage where they're like, what? I have to learn about this now. So there's always new things getting
basically
invented.
If they have an uncapped loan after they raise their money, it's basically like free money.
Kind of. I mean, I think the thing.
What's the downside?
Well, you're not thinking about what your cap table is going to look like when you take that next round. Like, even though it's free money, you have increased the hurdle because the next investor is going to say, well, I mean, before we wanted to know what you'd accomplished with 10 million, and now we want to know what did you accomplish with 15. So I think it's like it can feed a psychology that's dangerous, that it's free and it's not totally free.
Well, yeah, it's never free, but it is very loose on the.
I mean, it's great. Yeah. I would happily, take that kind of a deal if I was looking to extend my runway. It's even better than debt, right? And it's competing with debt. It's saying, take money from us. Don't go to one of these banks. Just, you already know us. You trust us. Like, you would rather have us on the cap table, right?
Right. Yeah. So. The information asymmetry concept, I think, went out the window when the VCs largely moved from being Stanford and Harvard MBAs to being founders of companies. So probably about 10 years ago, the VCs were like, should we try to get Reid Hoffman to be a VC or Mark Andreessen to be a VC or, Roelof from Sequoia, who was at PayPal. Should we have those people be VCs or should we just get people straight out of business school? And once you start having operators and they start investing in their friends, the whole sophistication level, and it wasn't like one group was trying to take advantage. It's the same group of people now.
Right.
The entrepreneurs are now the investors. So the lines are not like they used to be.
You still have these new people coming into the ecosystem, though. I mean, we've had this influx of people moving to even the Bay Area to be in tech, and I think that they definitely still have to find a way to get spun up on. I just spend a lot of time with new founders answering questions, and I feel like there's just a lot of people who still have pretty basic questions that aren't getting answered.
When we get back, though, I want you to tell me what you think the chances are that things completely unravel and there's a crash, not a correction, in 2016. So think about that while I read the ad. And hey, this is really not even an ad. This is me telling you about a product I use all week long, and that's GoToMeeting. I love GoToMeeting because, listen, I take a lot of meetings, and it's a hassle to get around town, get down to the valley, go to New York, go to LA, whatever. And GoToMeeting just works because it's fast, it's on a private network, and I can screen share, and I can do HD video. And you can meet from any computer, tablet, or smartphone without all those crazy travel hassles and travel expenses. Your team can join with just one quick link. No signups, no speed bumps. It just works perfectly. And like I said, they do the HD quality now. So the fidelity is amazing. And the thing I love most is I have this little Chrome extension for GoToMeeting where when I put something in my Google Calendar, I can just click to make a link for everybody. So I make that just by default in case when I'm on, when the meeting's happening, I need to get somebody else on the call. I can just say, click the link. And what's also great is some people do it on their computer. Some people call in on their phone. It just works. And that's the most important thing with these. So I want you to try GoToMeeting today. Try it for 30 days free. There's nothing to lose. Visit GoToMeeting.com and click the Try It Free button. Do it now and you'll have your first meeting set up and running in minutes. And that's GoToMeeting.com for your free 30-day trial. I love it. I use it. It's awesome. Oh, you can also record the audio too. So if somebody misses the meeting, you can do that. And there's a little chat room there. So a lot of times I'll be throwing stuff into the chat room because, hey, you might have 5 different companies or 3 different companies on a call, 2 different lawyers. Not everybody's in the same HIP chat or Slack room. You use GoToMeeting, it's got its own little chat room there, so that works really well. Also, you can let other people, you can switch who the presenter is, and I do that multiple times during a call, and it just works. So thank you to our friends. All right. When I left for commercial break there, I was asking Katie and Danielle, what are the chances that this all comes apart? What does your gut tell you? Do you think and what are people telling you, Katie? You think there's going to be a crash? Because we've certainly had a correction.
Sure.
Correction being 10 to 20%, crash being greater than that, I think, in people's definition.
I think that it might be instructive to look at 2008 and 2009 again, where there was a crash in the system not caused by technology.
Yeah.
And we had the Goodbye Good Times PowerPoint that went around, et cetera, from Sequoia.
Yeah.
But at the same time...
As a Sequoia CEO, I got that. Yeah.
But that was fun.
Yeah.
Yeah, I'm sure you loved that. But at the same time, it did not kill the Silicon Valley ecosystem. It didn't kill technology. But technology and Silicon Valley were still impacted impacted by it. And I think we'll see something similar. Like clearly there's something happening in the larger global economy that is not right. There's a problem brewing. We don't know what it's going to be. I doubt it will be a handful of overvalued unicorns that brings down the entire global financial system. But what happens when there is a crash is that if it corrects here because the companies that we look at are losing their customers. And that is always the impact. So for example, it was that mortgage crisis that caused the 2008 collapse.
Yeah.
But it still hurt retailers like Walmart and Target because they lost their customers.
Contagion.
So there's a contagion. So I think we should be more worried about a correction and a contagion in technology than a collapse.
Right. Because we might get taken out because the Chinese economy collapses and goes into some
and
tailspin.
then customers go away. Right. Or the markets go down so much that suddenly companies are put into play as acquisition
targets. Or if all your
targets
customers are oil and gas companies.
Right.
I mean, all those companies are under massive margin pressure now.
And it takes away groups of investors too, because some of the sovereign wealth funds that come out of the Middle East are not as active as we would expect them to be because they're concerned about other things right now.
Yep.
Yeah. I wonder. I don't know how much of Apple's revenue now is China. Like it's low single digits, I think. Like the iPhone has not become so huge over there that it's going to take down Apple.
Apple takes China very, very seriously. They've opened more than a dozen stores in the last 2 years in China. They expect China to be their biggest market very soon. But Apple is a consumer company, and what's happening right now in China is a financial problem. It's a financial markets issue. It hasn't yet flowed through to the consumer.
Right.
So for now, as long as it's a market issue and consumers are still spending, Apple doesn't make money in China because of its stock. It makes money in China because it sells stuff that people want.
People buy iPhones.
Right.
And they have a great margin.
Exactly.
Yeah.
Exactly.
But Google makes no money in China, or virtually none.
Well, they're really not in China.
Yeah. Facebook makes none. So that's the thing that's very interesting to me. If China, I'm trying to think of the scenario where China goes belly up and things are terrible over there. It goes into some horrible situation. How that impacts American companies here.
Well, so here's one scenario.
Yeah.
China goes into a tailspin, the market drops, dragging down the S&P, the Dow, and the NASDAQ. Suddenly a company like Box, which Danielle and I were talking about before, their price is under so much pressure that they get put into play. And they might want to stay an independent, publicly traded company,
they're gonna get bought.
But suddenly they become such a tempting acquisition target because the market cap goes below $1 billion. Why wouldn't somebody buy that company?
Oh my God, I'm backing up the truck and buying the stock.
Right. And so then if you want to take a company public, what options do you have? I mean, so there is a ripple effect from something like a Chinese stock market crash.
Yeah.
One good thing is that, cheap oil and cheap energy is wonderful for consumers with a strong dollar here in the U.S. So on the flip side, if you're running a consumer company where individual people are making a buying decision about your product, it actually could be great for you because they're about to have a lot more leverage on their money. So as much as they're scared by the market, they're feeling the benefit when they have cheaper gas that they're putting in their car. That leaves room for them to spend money on something that might be a nice to have that they can now afford. So it might be interesting to see how that impacts some of these companies in a positive way.
It seems to me that people have had a pretty easy ride, Danielle, in terms of raising money. Mm-hmm. So angel investing, seed investing, it was like you met with, 20 people and you got 5 investors.
Yeah.
Some ridiculous ratio. I don't know what yours was in the early days, but when you came out of YC, right? Mm-hmm. It was fairly easy for everybody coming out. You had how many people in your graduating class?
I think it was very large, 80 companies.
Oh, you were part of the 81.
That was that massive
That was the peak.
But even then, I think, generally about half the companies coming out of YC raise money.
Yeah.
And it's a pretty amazing thing, really.
The other half don't.
The other half don't.
That's amazing.
I mean, the companies, I think Y Combinator is amazing, but the companies do die. It's not, each class usually has like 10
statistics on that, though. They don't, Techstars is public about their sick.
I mean, I'm sure they do.
Y Combinator is not.
I'm sure they keep them, but
They're
they don't
public.
make them. I mean, we have them too.
Yeah.
You can just see which companies are raising money or not.
What is the mortality rate?
I mean, off the top of my head, I would say in each class there's about, after a year, there are about 20 companies, and after 2 years, there's about 10 that are clearly making a lot of progress. And then you have some of these laggards that come along. You're like, oh, I kind of forgot about them.
Right.
And they raise. But yeah, at the end of the day, each batch, we point to like 2 or 3 companies in each batch.
Wow. And now the batches are over 100.
Right. So I mean, maybe the numbers will be bigger if they can sustain that. But Yeah, my batch included Instacart and Coinbase and some really amazing companies. And I look at them and I say, okay, those are the shining light from our batch.
Right. But when you met with investors, how many investors did it take you to get all these investors? God, you have so many, 150.
I mean, well, we used AngelList, so I will say I think that helped a lot. And that's a big part of actually what you're describing. I think it's easier because the communication is easier, finding these people. But yeah, I would say...
Oh, so a certain number of them are in the syndicate.
No, I'm just, yes, some of them are in syndicate, but as far as like the ones that I talked to, I'd say it was a coin flip whether or not I was going to get an investment. So half the time.
50-50.
I would say it's about 50-50. I mean,
what do you think it'll be now for companies? Like if you had to go out now the same way, at the same...
It might be the same, but I think that the challenge is some investors are just saying, I'm going to take a break. Because if you're a high net worth individual, it's not a bad idea if you get nervous about the market. Like I could just go up to Hawaii for 3 months for 20 grand, or I can invest 20 grand in a startup. So maybe I'll just chill out, go to Hawaii, not participate in the market. To them, they don't have a time horizon where there's pressure for them to invest right now.
Right.
So if they're worried, then usually the advice that they get is just wait. Startups can't wait, but they can't. The investors can.
That's exactly what I'm seeing. Is like a lot of investors are like, "Yeah, I'm going to be away," and Tim Ferriss was like, "Yeah, I'm not investing anymore."
At the seed stage, but institutional guys have a lot of money, and they have to deploy it.
They still have to keep investing.
Mm-hmm. So I think that the big numbers will continue to come from there, and those are going to look pretty consistent. And then I think we've already seen a huge decline in seed, and that's going to continue.
So what do you think the chances are on a percentage basis of a crash?
A crash being like the market going
50%. The startup eco. Let's say a crash would be similar to 2008, 2009. And I think during the dot-com crash, you were in high school.
Yep.
I'm not joking, right?
Like but I was trading stocks then too.
But you were trading stocks in high school. Yeah. So similar to those two crashes, what do you think the chances are?
I think it's a greater than 50% chance.
You think it's greater than 50% chance?
I'm a bit of a chartist. I think I think it may not be rational, but I think that there's a greater than 50% chance. That
will have a similar like crash.
Because of bear-style price action in the market and all this instability, even if, I actually think, to Katie's point, I would love to have a lot of money to invest in Box right now. I think there's going to be huge opportunities to invest. I think there already are things that are on sale, so... I don't know. I see it as opportunity.
Yeah,
it's just
I see it as
irrational, but it's opportunity.
But you think 50% chance that it comes apart?
Better than 50.
Katie, what do you think? You think does this feel to you like 2009 or 1999? Or, I'm sorry, 2000 when the dot-com crash happened?
So it doesn't feel exactly like 2007, 2008 to me because I'm not as close to the action. I was covering Wall Street and I was covering private equity and all sorts of debt instruments in 2007 and 2008.
Were you having panic attacks during that, like as a journalist? Like, did you literally wake up at night and think the world is ending? Because it was terrorizing to people. Did you literally have like massive
My office was directly
anxiety?
across the street from Lehman's office.
Oh, wow.
So as we knew they were going under, it was...
As they're carrying boxes out the front door.
Yeah.
It was really incredibly stressful. So not.
But did you feel it as a journalist? Did you?
Of course, because
was it the most stressful moment of your life?
As exciting as it was to report an enormous story, it was also stressful because our people who we knew, who were our sources, were losing their jobs, and you saw all of Manhattan shutting down. You saw Lower Manhattan bars, restaurants, things that had always seemed like they'd be open, shutting down. You saw people leaving the office at insane times over the weekend, and you were working around the clock. So yeah, it was really incredible. Wow. But in this case here, I don't feel like we're as close to the epicenter of whatever the problem is. So whether it's China or whether it's another debt problem, whether it's a lack of liquidity in the stock market, which is just being talked about right now, the fact that only 4 stocks were really responsible for almost all of the gains in the S&P last year. Whenever you see that kind of weird top to your point, you know something is wrong when investors aren't really participating, when they're just so, it was Facebook, Amazon, Netflix, and Alphabet/Google that were driving all of the growth last year. And when you see something like that, you know that in reality, investors are very wary. It's sort of like seeing these really low unemployment numbers, but knowing that in reality, there's something happening where people are not making enough money.
And they're giving up.
Right.
Yeah. There's some capitulation that has occurred.
When we were talking about debt, right? So, you know, we don't hang out in Minnesota next to the places where people are building, fracking rigs, or, we're not hanging out where people are doing oil exploration. And if those are the big chunks of debt that are going to go bad, we're not close to the action.
So do you think that we're not going to see any IPOs? Because you put out this big report on IPOs.
All right, let's take that when we get back from commercial break. When we get back from commercial break, that's a good tease. Thank you, Katie. When we get back from commercial break, Katie's pick, which is Uber cutting fares and going for volume. Big story. I have some feedback on that as one of the early investors in Uber. No, I have feedback on that as a customer. But anyway, and then we'll also talk about this IPO logjam and or who knows what's going to happen when we get back from this break. And hey, super easy for me to tell you about Envision app, which is, again, a product I use all week long. You can make mobile designs and clickable prototypes and get your design team and your product team and your clients out of email hell or HipChat or, some chat hell where people are trying to talk about the product on a platform that's not really designed for that. It's not designed, chat and email are not designed to have good product discussions. Good product discussions happen in Envision where you can put the crosshairs right on a piece of the prototype and say, this is what needs to change, or I have a question about that, and then click and CC everybody and have a threaded discussion in the actual prototype. And you can send the prototype to people in your organization or clients or prospective clients and say, hey, look at what we built. What do you think? Or send it to your board. Here's the next version. And they take it. And they're out in Hawaii or Aspen or wherever your board is at this time. And they put the new version on their phone. And when they're on the ski lift, they look at it. That's what it's about. You got to get the new product out to your constituents and potential investors and share it with them. And I always tell people, if you send me an Envision link, I'm going to click it because it's so delightful to look at your product and get an idea if you have any idea what you're doing. I can tell in 15 seconds, 30 seconds into a product if you have the chops that, make it so I want to have a meeting with you. And most of the time, 8 times out of 10, the product is so bad that people send me in a PDF or a deck that it's just like, if these people can't even make a decent product, like they're not really ready to get angel investment. They got to, that's 101. And Envision helps you get yourself out of the bucket of people who are incompetent in design and get yourself into the bucket of people who are competent. Airbnb uses it, Twitter uses it, Evernote uses it, Adobe uses it, I use it. All the people in my incubator love it and use it. And they're giving away their starter plan for free for 90 days. Go to envisionapp.com/twist, envisionapp.com/twist. It is awesome. I love the product. And go ahead, if you're a super fan of the show, and thank @EnvisionApp on the Twitter. They love seeing that. Okay, when we left, we were talking, Katie was asking Danielle about IPOs. What do you think? What's going to look like this year?
So 2 questions in one are, will there be IPOs and should there be IPOs?
Right, okay.
So the first one is will there? I think people are totally freaked out about IPOing in this environment because it feels very unpredictable. There's a ton of volatility. So I can imagine people with plans might be just taking the same approach as investors, hey, let's just wait. We've got cash, we're fine. We don't have to do it.
I think we're seeing that with Practice Fusion right now. They hired JP Morgan last year. They wanted their IPO to happen in the beginning of 2017. And now from what I can tell, the board is having a very serious discussion about whether or not that's realistic or if they should just sell.
I mean, the flip side is maybe it's really great. Maybe it's a really big opportunity. One, expectations are low. So that means you're not going to necessarily get the crazy price that you want, but expectations are low. You can enter the market unprofitable. People are going to be thrilled to see any growth whatsoever.
Right.
If you have a company that has cash in the bank and this is going to give you access to more cash for growth, while everybody else is waiting, you can go get $100 million and you can go hire a bunch of talent and get out ahead of your competitors.
And have a liquid stock to go buy other companies.
So the question is, are you going to let the kind of financial engineering view color how you decide to IPO, or are you going to think about how you can take that money that you're getting? I mean, it's not an end game. After you IPO the company, the next day you go to work and you run the company.
Right.
So to me, I think, frankly, I wish we were 3 years further along.
Yeah. I
would love to IPO into this market.
Yeah.
I feel like I have a ton of opportunity where I want to take money and put it in my machine and build something. And I think there are a lot of companies like that. You can't say that of the 380 whatever unicorns that there aren't some great companies in there that could really do cool things with that money.
Yeah.
So should companies IPO? I think there's some companies who should IPO. But will they? I think investment bankers are probably telling them, hey, we're freaked out by the financial indicators, and that might cause them to not do it.
Yeah. The people I'm talking to, they're just like, wow, this is a great opportunity to buy up these companies before they IPO. And that's, I think, the M&A possibilities in a down market like this with so many cash-rich companies. I mean, things could go supernova on M&A because Twitter's $11 billion with $1 billion in revenue, or a $10 billion company. Really? It was a $50 billion, wasn't it a $40 or $50 billion company last year or 2 years ago? Why doesn't somebody, Google or Apple or somebody just Microsoft just go in there and snap them up for 15 or 20 billion.
I mean, you could argue that all 3 of those companies actually have a huge problem, though, which is that none of them seems to have a really clear strategy for why these acquisitions fit with what they're trying to do overall, as a bigger vision. Honestly, I think those 3 companies all lack vision for long-term innovation to some extent beyond the stuff they do themselves. So they might be thinking, what if we buy these companies and then we mess it up like we usually do?
Well, I mean, Google bought if you look at the big winners, YouTube and Android, and those have been quite material.
Yeah. So I guess, if 1 in 10 is that,
1
it's
in
worth
100.
it. 1 in 100. It's worth it. It's absolutely worth it.
Think about it. 1.6 billion for YouTube. If that was a public company right now, it'd be worth 75 billion.
Man, that would be a fun job to be corp dev for them. Whoever's doing that is probably having a lot of fun.
I think both of those. Android is making them $10 billion or something a year, $20 billion a year, according to the Samsung
we have
lawsuit.
the Oracle suit.
The Oracle suit, that's something like, I heard 20 billion or 10 billion. They're debating what the number actually means, but because it might be, who knows, it might be before they split the money with the partners, but it could be, these two businesses, if they were independent, would be $50 or $100 billion businesses each.
So this is why it's good to have some of your VCs be finance guys, though, because the M&A value add that they offer.
Or gals.
Or gals, apologies. But, for them to be...
we're very cognizant of, and by the way, for the audience, we're going to try to have more men on the program. I apologize in advance. But
sorry about it.
We went with the smartest people available.
So I think that, it is helpful to have folks who are familiar with M&A, and that's ultimately very rarely going to be the operators because they've only had maybe 1 or 2 transactions, whereas the finance guys
someone like
done
Bill
dozens.
Gurley or the people at Sequoia.
Really helpful.
Yeah, they know.
And they know what to expect.
Yeah.
I think it's important to note that we're talking about companies that are doing well right now, where things like an M&A event would be really positive. The flip side of that coin is you have amongst this group of hundreds of unicorns, companies that are struggling. And their investors also want an M&A event, but for a very different reason. And it's
They don't believe in it?
They don't believe in it. And they know that if the company goes public, the stock could fall and get taken out at a lower price than the IPO value. Everybody loses money, or they can control the situation when they're still in the driver's seat as the folks on the board who are also the investors and say, we have these liquidation preferences, we're going to push for a sale. And as long as we clear the hurdle of how much money was raised, we're fine. And that's okay. So there are 2 different kinds of M&A discussions happening.
The unicorn thing seems to be super overblown to me because, yes, things got a little bit frothy for sure. But you don't get to those frothy valuations if there wasn't a core there, or you rarely get there if there wasn't a core. So Snapchat is just wildly addictive. There's a ton of people using it. Is it worth $20 billion or $15 billion or $10 billion? Who knows? They've only got $50 million in revenue or something. Mm-hmm. So yes, it's on a revenue basis is wildly overvalued, but it is still a very significant company, right?
Bubbles are great because things that would not normally get funded that are wonderful products finally get funded. So bubbles are really good until they deflate, and then you really have to make sure that you're positioned to be a survivor.
Yeah, but look at if Gilt Group, Fab, and One Kings Lane, if all 3 of those have not imploded.
3 things that I've never spent any money on ever.
Yeah, we should see my house.
Yeah.
There's a lot of One Kings Lane boxes.
I don't know. I guess the
a
startup budget is just a little.
Anyway, those 3, it's just like it was a category didn't work, right? Very well or long term, but Fab was.
Well, we're also seeing categories start to go away, where the exuberance didn't just fund a couple of companies that didn't work, but categories that didn't work. So look at what's gone on with Groupon and Living Social. That category, I think we know Daily Deals is not as a category as big as we thought it was going to be. Again, One Kings Lane and
flash sales.
The flash sale stuff. Yeah. That category is going away. People are starting to question, okay, this on-demand delivery thing, is it the category that needs to improve, or is it just a couple of companies within the category? And I think we're seeing.
What do you think about that on-demand category? Because you have Instacart, you have Sprig, you have.
I have a whole on-demand bucket of stuff on my phone.
Eventually, they're going to have to raise prices to make money, right? And then we'll see which companies really worked. So if suddenly I have to pay $20 to get something delivered that I once paid $10 for, I better like it a lot, or I'm not.
Have you had that experience here?
They're just starting to raise the price.
No, you personally. Have you personally had an experience of a product that the price went up, and you just had to make a decision?
Not yet, because things have remained so cheap.
Yeah.
Though I will
Which ones do you use? What do you like?
Oh, so I used to use, I'll say I used to because my coworkers so mocked me and so shamed me
it's gonna be
for using Postmates.
Postmates.
Actually, I was going to say
do you know
that
how much
too.
money, then you looked at the bill and you realized you were spending $15 to deliver 20.
Spending $15 to get a cup of coffee and a croissant one day, I think was probably my low point.
Really?
And when David Streitfeld told me he would have done it for $5, I knew that
I'm like, wow, New York Times is paying really well.
I just had the same thing. I was like, I think I know why the New York Times is struggling. How much are they paying you, Katie?
I mean, you're awesome, Katie.
I had the same experience with a friend of mine, and I was like, they were telling me about like Postmates, whatever. And I used Postmates last night. There's a couple of places that are really good that I want to. Like I ordered pizza for my poker game last night from what's the name of this really good pizzeria? Anyway,
when you spend like a couple $100 on
Tony's
pizza,
Napolitano?
it's okay to spend $20 on delivery.
Delfina? No, not
Delfina's pretty good.
Yeah, Delfina, I think. Anyway, I'm spending like a little bit more money than I want to on delivery, but I'm like, you know what? It's $200 and stuff, and if I have to spend an extra $20, it's
That's
like
not so crazy.
It's not so crazy.
It's when you order Taco Bell for for me, like $8 of Taco Bell from the marina, and it's like $25 delivery fee. It's sort of ridiculous, but I do that.
You do that?
Occasionally.
So far,
I get
resolution.
So anyway.
No more Postmates.
So anyway, Postmates is definitely like one of them where it's like you see that margin. The other one I saw was with Lux. I was using Lux driving my car. Listen, I'm an Uber investor.
I'm making this decision right now about Zerks, by the way, so I'm curious what you
so anyway, I was using Lux, and it was making me late sometimes because I think they were struggling with their growth.
Yeah.
But they started at $14 a day in the Tenderloin, and I was paying $10 plus I give the guy a $5 tip. So it was like, I can have somebody outside the door and not have to wait in line at the parking garage.
Right.
But then I went for the monthly for $2.99, and I was using it like twice a day, and I was like, well, this works out because it's costing me $10 each time I park. But it was everything was late. Everything was late or missed calls or whatever, and the drivers lost. So they were having struggles with that. But then they just raised their prices. They popped everything up. So now it's like $30 or $40 to park in areas around here. So it's like, it's clearly not worth it.
Yeah.
And then with Uber dropping its prices, I have gone Uber Pool 1 out of 4 rides, and then Uber X 3 out of 4 rides, and I'm going full Uber. My wife's like, are you taking the Tesla today? I'm like, no, you can have it. She's like, why do we have 3 cars? I'm like, I don't know. You should sell a car. I'm just going full Uber.
So I'm a big Lyft person. I know you're a big Uber person. I feel like that's interesting, except for what about the drivers?
It's been great having you, by the way, on your last episode here.
I'm looking forward to the physical confrontation part of the show.
It's been really great having you here.
I mean, I'm not an investor, but I'm curious, do you think that means the Uber drivers are going to make less money, or are they just subsidizing it by paying them
I don't know the details, so to be clear,
I know I shouldn't ask you detailed questions about
it's
this
fine
company.
to ask me because I'm always very clear about it.
Well, the driver blogs would imply that they're not subsidizing because they're pretty angry.
They're pretty angry. I mean, that's a problem because with Lyft, I think at least tip people. Do you tip on Uber?
You can't tip on Uber.
Yeah.
I always
and that
tip
to
on
me,
Lyft. I always leave $2 just like I would in New York. If I'm taking a cab, I'm taking a cab.
The thing with the tipping is it adds another level of decision making to the process. So you have really one decision, like where you are and where you're going. It's like you put that in and you're kind of done. I guess you have to pick Uber X or what you're going to take, but most people don't change that, I think, too often.
Yeah, they just do the same thing.
So if people do the same thing, you're basically picking your destination and you're done. If you then get surge pricing, you have to confirm that. So that's a second decision. And then leaving and having to decide the tip, you have the rating, you have to decide tip. Now you'd be at like 4 decisions instead of 3 or 3 decisions instead of 2. So it's either 33% or 25% more decision making. So that's the problem.
Yeah, I mean, I guess to me, it's like, I always wonder how it affects driver quality for them, if they can
We'll
attract
see.
the best
I mean, every
drivers.
time they've done a cut, my understanding from reading the press, not from inside information, is that they've always made the difference up or they've guaranteed the difference, and that they've always been right. So if you lower I know anecdotally, people are using Uber more this January since they lowered the prices.
Yeah,
Demand, people are using it more. Like for me, it became, I literally made the decision, like I'm going to sell 1 car and I'm going full Uber.
I mean, they just want to kill Lyft, right? They need to basically get every single person to use Uber as their main service. Like, it's very valuable for them to just
I don't even think it's Lyft, to be honest. I don't think they need to kill Lyft. I think what they need to kill is car ownership.
Didn't the Yellow Cab San Francisco go bankrupt just recently?
I don't know if that's a company or it's like one of the 10 companies.
It's the largest cab company in San Francisco.
Yeah,
so that's who they're killing, right?
They have an inferior product. I mean, does anybody really want to take a taxi?
But they need to scorch all this stuff. Actually, it's really funny with Box. It's actually a similar scenario. One of the best benefits of Box's price getting lower in the public market is all of the stuff they want to buy is pegged to their valuation.
Right.
So as their valuation is going down, Box could also go and snap these things up. I just wonder if Uber could take a similar strategy of driving down the value of things it wants to acquire.
Yeah, I don't think it has to. I think they really want you to get rid of your car. I honestly think that there's only a certain number of people who do taxis. So really, when people look at it and say they're trying to kill Lyft or they're trying to kill the taxi business, I think that was the story 2 years ago. I think the story right now is, will people get rid of their cars?
In urban areas only then, because I grew up in Vermont, we weren't getting rid of
In Vermont, no. In LA, yes. There are people in LA, which they said in LA, you will never give your car up. There are people I know in LA who are full Uber now.
Yeah.
And I'm like, how do you do that? They're like, well, it costs me probably the same or $50 more a month, but I get all that time back. And I'm like, so there's a theory that right now, the rent-a-cars, right? Like why would you rent a car? You go, it's so painful. You just go full Uber, right? So I think the same logic will apply to owning a car. Like, do you guys own cars in the city?
I haven't owned a car since I lived in New York, so
I drive it like never.
You drive it never.
I have Zerks because I was like, I guess I should drive my car. Then I need to deal with parking, and I'm just like, can I just get out of this now?
Right, and
I probably will about a year from now.
Because here's the thing that I realized, and David Sachs was telling this for years, and I was like, well, I kind of like driving. I have the Tesla. I like, whatever. But I also like being able to have my eyes closed in the car, which you can't do when you're driving, or make phone calls and not be distracted, or do email. So now I'm really enjoying getting that time back. It's like 10 minutes, 15 minutes, 2 or 3 times a day I get back. It's like getting back almost an hour a day.
It's pretty great.
Yeah.
So my question on Uber, I just took Uber in LA. I don't drive.
Right.
So I just took Uber in LA from West Hollywood to Santa Monica, and I think the ride cost $12.
12.
So 12. So because there's no surge pricing,
And it was
extremely cheap.
30 minutes?
30 minutes.
Right.
At what point does Uber flip the switch to make that ride profitable? That's my question, because I'm pretty sure I was in the car for 30 minutes. We burned some gas.
I mean, who cares about profitable?
Somebody's time.
What's the how about just positive gross margin?
I think actually, if you think about it, it's
so
$24 that would be like $25, let's say, for the full hour. And if you're in a Prius, you're not burning that much gas. You only went 5 miles. That's only about 5 miles. West Hollywood there, 6 miles maybe.
So what's the hourly rate for the person driving the car, though?
75% of that.
Okay.
So they would be making $16 or $17, I guess. That's a lot more than Target.
Yeah. So that might work.
It's more than Starbucks.
Well,
but that would mean you had 100%.
But you would have to back out the safety fee, the $1 or $2 for the safety fee.
I did. That's right. I took 75% of it. Yeah.
And then of that, the drivers get a cut. So the drivers have been complaining more and more. So one of the things that was interesting about the Uber story that we're going to talk about is that
what's minimum wage in California?
$10.
So if they only are at half utilization, then that's below minimum wage job.
If they were at half utilization, yeah. But I don't think
they're
you can charge the time when you're waiting for a call as part of your hourly salary.
But I'm saying for like a person, a human who's like, I'm going to be in this car 10 hours, like whether or not they are driving, like that time they don't get to spend it on something else. So effectively they only
they
get
read a book or you can wait for a call.
Right, but it's not like Target where you're getting paid for every minute that you're there.
Yeah. Right. So that's
the rub.
That's a slight rub. But then you also don't get the benefit of the surge pricing when you work at Target either.
So if they reduce prices, it's good because they can increase utilization, which is perceptive, like for the individual driver feels good.
I think at the end of the day, they're aggressive at experiments, obviously, and they're aggressive at getting people to use it more. At the end of the day, if there's a better option for drivers, they'll use it. And I see drivers with Lyft Open and some of the other delivery services, like they're all doing 3 or 4 services. So the second anybody doesn't pay enough, they switch.
Sure.
Like I had a driver recently who I was in an Uber pool and he was double clicking his task manager on his phone to look at Lyft. So he was setting up his next call on Lyft while finishing an Uber pool, which I think is some sort of hack.
Is it a problem for these companies that they can't keep a stable labor force? I'm curious. I'm genuinely curious because if you're a company, Uber, Lyft, or any other company, an on-demand company that has a labor force that's constantly shifting and is willing to abandon you if they don't like you, then you're not just thinking about the normal levers that a business has to think about. Suddenly you're also thinking about a turnover rate that most businesses don't have to deal with.
I don't think they have a massive turnover rate. I think they need more drivers, but certainly because people are using it more. But I don't know that they're going to have the turnover rate because this idea that you can work anytime you want for a couple of hours is super powerful for people.
Well, I think some other businesses like Starbucks and McDonald's and Target do have high turnover actually. So I think
they do because you're forced to work the hours they want, and they're doing really weird things like you have to work 4 hours. Then take 4 hours off, then work 4 hours. Like
they've made changes to that because people were so unhappy.
Yeah.
So Starbucks, for example, because they weren't creating rational schedules for people, there was a big story. There were a couple of large news stories about it, and then Starbucks came out and said, we're not going to do that anymore. It's too disruptive to people's lives. It doesn't really give them true flexibility.
So basically, if you push the labor force too hard, it will self-correct. I mean, I think that's where people get a little ahead of themselves as they think, oh my God, Uber's pushing too hard this way, Lyft, whoever's pushing too hard for whatever, Instacart.
Right.
And it's like, these people are opting into it and they're making greater than they are at the other competing jobs. They can leave at any time and switch to the other competitor.
Right.
People have to keep that in mind.
Something interesting about Uber, and this is neither praise nor criticism, is that if you look at a company like Amazon, they decided to go public pretty early on, and they have not been profitable forever, right? They spend most of their lives publicly traded and not profitable, but they took that money because an IPO is a fundraising event. That's all it is. They take this big amount of money and the liquid stock, and then later start doing very interesting things. AWS, this sort of subscription service that's made them extremely popular, and now video
started with
and
books.
movies.
Books only.
All started with books. And they went public with their first idea, knowing they wanted to do all these other things. Uber is taking a very different approach. Instead of going public with the initial idea, which is basically the better taxi cab service, they're probably not going to go public until they've done all those more experimental things, their version of AWS, whether that's self-driving cars. And I just wonder how the investors, public market investors, like very simple, straightforward stories, how they will feel about that. It's an open question. I'm not saying it's good or bad.
I think the good news is, like, based on the leaked numbers that are out there, like the revenue numbers are demented. Like, I don't think anybody's
so
ever.
So are the loss numbers.
Yeah, but if you're growing at that pace, at any point, I think you can flip the switch and be profitable. So
how will they switch
how do they flip the switch?
How many people do they have to fire to do that?
They don't have to fire anybody, I don't think. They just could
stop hiring and get.
I think if you're expanding into markets as fast as they are, you have to invest.
But when you say flip the switch, what
does that mean? They stop
actually
expanding into markets?
I think they would stop expanding to markets, right?
Okay.
They would reach the saturation point, right? I don't know how many cities are in now, 350 or 400
right?
or something,
yeah,
right? So
more than anybody else.
How many should they be in? 1,000,
and then most of the markets
1,500?
they're losing money in. So then how do they make the individual markets profitable? Or not profitable,
I think that the big markets are easily profitable. So I think they understand their playbook. Like, the market goes like this and then it hits profitability at this point. So what you can assume is, like, if San Francisco, New York, and those places hit profitability, and I don't know this for a fact, but I think, like, when they launch 100 cities and there are 100 concurrently not profitable, I think they know exactly what month, maybe what week, maybe what day it'll trend to profitability, right? Because they buy supply in markets, and then it takes a certain amount of time to get the market going and get the users. So
as long as they run a playbook where they get better and better at that over time, then the idea is that they get more and more control.
Yeah, I mean,
That's really interesting.
Yeah.
Aren't they a supply chain company? I mean, I love what you were saying about Amazon. It immediately made me think, oh, wow, I'm really actually very excited about this Uber future, because they can take what they're learning about routing things and people, and they can apply that at a much bigger scale.
Yeah, I just read today that the Uber Eats app is going to become its own app.
Yes.
Yeah, I love
So that's a big
and
step.
then now people are toggling between, the same person who's driving your car can also be your Uber Eats guy. Why don't they just go devour all of the, no pun intended, devour all of the other on-demand stuff?
I think their model is to carry other people's food.
Right.
So I think they might take the best dish from
laundry is another one. I use Wash.io.
Yeah. I mean, all these services, it's I think all those services, I think eventually will plug into the Uber API, and they'll be like FedEx kind of a
pretty
thing.
cool.
Which is a pretty good vision too. I mean,
I just would like to live in that future. I think from a personal convenience perspective, I could manage all of that through one app. That's pretty cool.
Yeah. I think everybody's going to use like 4 or 5 of these services. And on demand is going to be here. Yeah, there's no doubt. I mean, when you look at people in other cities have no idea what we're experiencing here, right?
And we're living a couple years in the future, aren't we?
It is kind of like that. The fact that, like, we could order cookies here right now and have like Dobie cookies or whatever this company is. We could totally get chocolate chip cookies here within like 15 minutes. It's bizarre.
This is the future.
We're going to be really fat in the future.
All right, let's just wrap up with a little bit of Apple talk. They bought this company, Emotant, and I was trying to figure out, why does Apple want a facial expression analysis company? Is it because they want to do something in iPhoto or Photos app, because they already have facial recognition in there? Or do they want to look at your face? Like, I guess Samsung phones, you can look at them and it unlocks when it knows your face, but then you can just take a picture of yourself and hold up a picture of yourself. Why did they buy Emotant?
So I think that a couple of things are going on at Apple. They realized they're really deficient in a couple of areas, including machine learning, artificial intelligence, and virtual reality, which are going to be either huge platforms or huge drivers of software growth and innovation. And they are certainly far behind Google in this, if not other companies. So we've seen things like acquisitions of a facial recognition technology company, which would allow them to do more around FaceTime and services that they already own.
Yeah.
And then also, I'm just looking at the Financial Times. They announced that Apple had hired Doug Bowman.
Yeah.
And so Doug had been a computer science professor at Virginia Tech, where he had been director of its Center for Human-Computer Interaction for around 5 years. So they hired a really big guy coming out of VR as well, because they're playing catch-up at this point in terms of software.
Interesting. You have any thoughts on it, Danielle?
I mean, I think it's a talent acquisition. I totally agree. I was thinking it would be funny if they actually were looking at your face to see a reaction to the content or ads that you're getting and making that better. But I think that maybe sounds a little crazy now that it come out of my mouth. So
yeah, well,
but actually, it would be fun to build that.
Well, if you look at like Echo, like I have an Echo now, and it's always listening in my kitchen.
Do you like it? Has it been convenient for you? Have you?
It's incredible.
Do you swear at it ever?
No,
Does
but
it
my
know
daughter
you're-
goes up to it and goes, Alexa, play loud rock and roll music that'll make Daddy angry.
Oh, that's
I'm like,
adorable.
keep trying. It's not going to make Daddy angry at all. You know, like, so, but she's like, really, then I'll give it a command. Then she gives a command. The best command you can give Alexa. So everybody who's listening to this podcast right now, Alexa, set a timer for 10 minutes. And it will set a timer for 10 minutes. So while you're cooking, you got your hands and you're making eggs, where you're like, Alexa, set a timer for 10 minutes. Alexa, set a timer for 5 minutes. And Siri will do this too, but it's so convenient. And literally, you could be 50 feet away from it and it hears it. And then you're like, Alexa, play KQED. Alexa, play This Week in Startups. Alexa, play the next episode of This Week in Startups.
So you have an iPhone though, right?
I do.
But you don't use Siri for this stuff.
No,
you
Siri's terrible.
Does it just feel like Alexa's like
Siri.
made for this?
It feels like Alexa is made for this. And then the fact that it's also hooked up to your Amazon account and all of their services, and they're a more open platform than Siri. So Apple's closed nature is a detriment to an AI voice recognized search service like Siri or Alexa. So Alexa is just kicking their ass because Alexa's so open. Now people are iterating on it and hacking it. So like somebody made a server that you can put up that makes it interface with your Sonos. So you can have Sonos and be like, Alexa, play this on the Sonos in this room. And it plays it. Alexa, play this on the Sonos in that room.
Pretty amazing.
Yeah, because the most rudimentary, an extremely rudimentary way of thinking about this is that the more information a service like this can have, the better it will be and the smarter it will be. And by being
it's better.
Exactly, and by being sort of
some
walled
cases,
off,
open's
you're
better,
not going to get the information.
Open's better when you're behind, like you're playing catch up, right? Like Android
and Google
was.
had been working on voice for a lot longer, right?
Yeah, and Open is better
Applebot.
when you need lots of data, reams and reams of data. So iOS is just, they really have to open up Siri more. But it's super impressive, like this thing, like how accurate it is. You're like, Alexa, order more coffee. And it's like ordering 8 o'clock coffee because that was your last thing. And if you program it properly, it'll just do that of stuff you've ordered. If you haven't, then you have the app in your hand and you say, Alexa, I want to order some espresso beans. And it says, number one most popular espresso beans is this. And when you have your phone, you see it come up.
And this is, of course, on Amazon.
Sportscasting. Right. And then you're like, okay, I'll take that one.
Yeah.
And then it orders it. And you're like,
Amazing.
oh my God, scary. And then it's like, my wife had one account and I have an account. It's like, Alexa, switch accounts. So it will go to my wife's account and then go to mine. So then it's like, Alexa, play smooth jazz. Alexa, play Bruce Springsteen. It just does it.
And every single thing you do, it's learning more about what you want. So
Right,
for
but the
Amazon,
NSA is
that's
listening
amazing.
too.
Well,
So if I'm like, my God, I really would love to join ISIS.
Sure. Just over
Alexa,
breakfast.
how do I join ISIS? It'd be like literally the doors and the windows come crashing in.
I think you should try it.
I think that like it's pretty, if these things will be hacked and people will have all their recorded conversations taken, because it's persistently listening to
I mean,
you.
I don't think that are our conversations that interesting.
Doesn't matter. A lot of people have had their cameras hacked. Like I put a, what
Not
do
saying
you
it
call
should
it?
be hacked.
I keep a, what do you call it? Like you do
I
over
do
mine.
as well, as you
See, look,
can
the
see.
New York Times reporter has a Post-it over her camera. Let me tell you something, folks. She's not crazy. She's not a truther. Do you believe the World Trade Center was knocked down by George Bush? And the Saudis on purpose?
No.
No,
I don't.
okay. But you do believe that somebody can hack your MacBook Air and watch your video without turning the green light on?
Somebody demonstrated it for me. It was incredibly easy. Yes.
Yeah, it's happening all the time.
I think one of the things about all of the the AI conversation, this constant surveillance, is that this is one of the few times where we've seen technology move so far ahead of what we as human beings have decided on as morally okay that it becomes very confusing. I mean, when the PC revolution happened, when the mobile computing revolution happened, we as a society didn't have to get together and say, but what does this mean for how we treat one another as human beings, and what does it mean for our government? It was only when we started seeing things like, oh, the camera in Google Glass and other sort of creepy versions of constant surveillance that people started to get nervous.
Yeah. They've been boiling us frogs for a while.
Exactly.
And like now it's like, yeah, no, it's totally cool. Cookies are like, no big deal. We're tracking you. And oh yeah, your phone, and we know who you are and where you are. And
Alexa
now
knows every time your daughter's upset with you.
Well,
Alexa will soon be recommending therapists.
Interestingly, machines can tell if you're depressed. Like from video. So like, and then Facebook was doing these experiments where they're like, let's put depressing news on your feed, or let's put, positive news on your feed, and let's see if it makes you use Facebook more or less.
Yes.
Because why wouldn't Facebook show you more depressing news if it made you more engaged and then more money?
They apologize for that, but it was never clear if they stopped doing other sorts of experiments.
Yeah, I can't really figure out if it's just the people that I follow.
It's like my friends are really freaking depressing.
That's it. I'm
honestly, you people, I've got to start following you. You're so goddamn. I need new friends.
Actually, I do feel this way after the stock market the past 2 weeks. I'm like, I don't know if I can read Twitter anymore right now. It's just not fun.
Here's the thing. I used to be like you. I see a lot of me in you because I was like a very aggressive.
So you're gonna let me come back?
No, of course I'm gonna let you come back when you delete. I'm gonna make sure that lift is deleted before you leave.
All right.
Okay. If I see you in no, you know what? You're very aggressive and very successful, and you're very good at what you do. But I wanted to tell you about the zombie thing. I would do that kind of stuff exactly like you. I was a sharp-elbowed, crazy publisher, and the more crazy, the more I publish it. But here's the thing I learned with the zombie stuff. We all know which companies are going to die, and if you ride them too hard on the way down, you don't know where those people are going to be next, and you don't want to burn out the channel too much.
Yep.
So pointing out to me or Mark Andreessen or whoever, or Saka, whoever these people you've curated these great relationships with as a young founder, we know those 4 companies are going to die, and we're in meetings with the founders who are puking in the shower. And if you jump on top and I know it's dying too, and you broadcast it, it's like, yeah, we know that person is puking in the shower. Like literally had a founder call me puke in the shower.
Yeah, I mean, it's not for you guys, though. We know it's that the rest, there's this information asymmetry. The rest of the world doesn't know. And then people go join those companies to work there. Right. So and it's kind of a big deal for them.
It is. But if you make a list of everybody dying, it's there's a fine line between going over to the value-add Gawker side and what do they call it? Schadenfreude? Schadenfreude?
I mean, I'm definitely not excited to see companies struggle, but I definitely feel bad for my friends when they join companies that, end up really messing up their career. So it's a fine balance.
Also, you can scarlet letter them. See, here's the other thing. This is the thing I've learned. With great power comes great responsibility, Spider-Man. You now have power. You have a following. You have data. People saying, hey, Danielle's got data. If she's going to say something, it's probably true. Right? And so you have to be really careful because let's say you do say hey, here's my list of 10 and one of them isn't on the list, but now somebody saw it and they're like, yeah, I'm not going to take that meeting. And you just cost them their funding because you scarlet lettered them because
arguably what cost them their funding was probably not me.
They could have been on the bubble.
I guess the interesting question is are only the people with a lot of money in the Valley who are the investors supposed to know the truth, or is everyone supposed to know the truth? I think that's a really key question this year, and I definitely agree we want to be careful, but there is a little bit of making sure that people actually have access to information that's important.
So the advice I'd give you is if you're going to write zombie companies, it looks like you're dancing on the grave, right? It's you're kind of poking fun at people.
I'll just have to find a more nuanced way to spread the truth.
Well, listen, and I might have said on this program 20 times zombie companies, we're going to have a bunch of zombie companies. But when you say Mattermark's a zombie company, that's when it becomes personal. So anyway, you got to be careful because
it's not personal.
Okay, it's not personal. But if you don't actually know and you haven't confirmed with the company that they're going out of business, which is what you would do as a journalist, and you're doing it just based on data, and you're saying these could be the ones that are going out of business.
That's why Danielle hired Alex, because he's the head of editorial, and now he can make that call himself.
Okay, perfect. Well, now we've hashed it out.
There we go.
No, it's very much in my mind because I've struggled with this my whole career. And now that I really have a mega platform, I was on CNBC and I was talking about Nest. And I was like, They're like, oh, what do you think of Nest or whatever? And I was like, it's kind of a troubled unit because, I see a lot of people leaving and they're all coming to me to start new companies. And then the drop cam transition to Nest was terrible. Like the product got screwed up. Then they had the recall on the smoke detector. They had the recall on the thermostat. I said, and
my Nest is currently set in Spanish because I just cannot figure out. Anyway.
Yeah. And then I let slip and I said, and people just don't like working for Tony. It's just a little, and I was like, should I have said that or not? And now I felt really bad.
That's not data.
I know. Well, it is data for me because I've had 10 people say to me or
Right.
5 people say to me, my God, I can't work for this guy. He thinks he's Steve Jobs. He's not. And he's just too hard to work for. He doesn't listen to anybody. So it is data for me. It's actual, legitimate, real data. But I said it on CNBC and then I'm like, well, I'm a commentator. And so you just got to be careful.
So did Tony call you?
No, Tony doesn't care about Jason Calcanis, but his PR people went crazy calling me, and I had coffee with the woman who's his comms person.
Really?
I shouldn't have done that because now I'm like all involved in it, and I don't want to be all involved in it. And then right after that happened, I was on This Week in Tech with Leo Laporte, or New Screensavers rather, his other show, and the Nest. Nick Bilton's Nest broke and his baby's, going to get pneumonia because of it, whatever. And I'm like, oh my God, yeah, what a disaster that company is. And then I said it again. I'm like, oh God. So you just got to be careful.
Yeah, no, I think we should stick to factual information like the company's lost half of its employees or the company clearly has stopped spending money on traffic because their website traffic is down 80%. Those are,
facts.
and that's generally what we're using to build these lists of companies that are in
just
trouble.
Be careful.
What you describe as a very Silicon Valley phenomenon as well, this idea that if Danielle makes a list, it could upset people who could help her in the future. And that is something about the Valley that makes it both a very powerful place where everybody's very positive and things grow very quickly because it feels like a closed system and people are very clubby. But it also means that it's really hard when things aren't positive for people to understand and know that it's okay to make people upset.
It's okay to make people upset. Agree 100%. The thing is, if they feel that it's unfair. So if the list is fair, nobody will have a problem. It's when the list gets unfair. So if they feel you're scarlet lettering them or zombieing them and just sort of poking fun at them, it's sort of like Pando, right? Like nobody takes them seriously anymore. They burned every bridge possible. And some amount of their journalism was good. And then this constant attacking of people and screaming, and Paul Carr on Twitter screaming like crazy. And the attack journalism works to a point. But if you go over what's fair, like Valleywag did or Pando did, and people feel it's unfair, that's where you lose the credibility.
Danielle, if you guys start doing attack journalism, I guess.
The good news is Mattermark is my only company, so I'm not really too worried about it. It should be an interesting year. We're going to find out what happens.
It's going to be a great year. I mean, it is interesting. Journalists being attacked, like the Wall Street Journal for the Theranos story.
Why?
I mean, not everybody's going to be a winner. I think that's the thing about fairness. It's unfortunately, 95% of startups fail, and most VCs don't return their fund, and that is the truth.
Yeah, you just got to be fair in reporting the information.
Absolutely.
That's where I was a little concerned with the
I mean,
Twitter
it was
shit.
a private list behind a paywall, right? It wasn't like a
No, I know. I was just talking about the tweeting of it. I've identified 100 people who are going to die. Be careful with that, approach. Not the data, but the approach to the data.
I think the key is to report the data and help people understand the why.
Right.
And having Alex on board is going to make that really easy for us because we can spend a lot of time on it.
Also, maybe you could give them a chance to correct the data before you publish it.
Sure.
That's another possibility.
Of course.
You say, hey, we identified that you haven't raised a round in this amount of time. We're doing our list of companies we think could have problems. If you want to correct any of your data, here's your data.
And news is cyclical like anything else. So over the last, 3 years, we had countless lists of companies that were going to do well and were going to raise tons of money and whose valuations were going to go through the roof. So as there's a pullback in financing, I think it makes sense to have lists that tell the other story.
Yeah. It's got to do it in a way that is, the packaging of it is super important. I don't know, maybe I'm just, I probably would be arguing your side of the argument 10 years ago when I was like a rabble-rouser.
I think we should go.
Now, what happens is...
now you're dressing like Daniel Craig and you feel
you're
very
an
established.
investor now. You have a dog in the fight on the other side, which I understand. We do throw up in the shower. It sucks to be the stressed out founder.
I just see that, when I see the other side of it, I have a little bit more compassion for it. But I don't have any compassion, honestly, for Theranos or Elizabeth.
Why?
Because I think it's a fraud.
Because she's a billionaire?
No, because I think that the way she attacked the journalists as opposed to putting the data out there and playing
Attacking
loose.
the sources instead of
attacking
putting out
the sources
data.
and instead of attacking the story and the data, I think to me made me lose all respect for her. And I don't know her, but I just have no respect for her and the approach she took, because she was yelling and screaming on her Twitter and getting other people to start attacking the journalists. And she's playing with people's health. And then when I saw
And people
Glossier's, what's his name? Jean-Paul Glossier, the guy who worked for.
Oh yeah, of course. He talked about taking the test.
He took the tests, and the tests were way
It
off.
was erroneous.
And then he emailed Elizabeth, and she didn't get back to him, and nobody got back to him. And it's like he's making health decisions based on a blood test that didn't work, and that got radically different scores. And then he had to like pull teeth. So I just think like how you react in a crisis is so critical, and the way they reacted is so indicative of fraud to me. Now I don't know it's a fraud, but I know that people who are involved in frauds respond that way typically.
You might get a call from Elizabeth's PR person just like you got one from Tony's PR person.
I'm never meeting with any more PR. Enough with the PR people.
I
Huge
agree.
mistake. I'm never meeting with.
Oh yeah, by the way, we're doing journalism, but please no PR.
No, I told them too. I was like,
not
listen.
interested. Sorry, we only
I
pick
told
our
the,
own stories.
I told the PR person, like, I'll meet with you, but it's only because I would like to do a fireside chat with Tony Fadell, because I think it's interesting too. I'd love to
I think your first question should be, why do people hate working for you?
Well, listen, I mean, you could find 10
people have told me that. Yeah.
Listen,
so
I mean, that's the least one.
would you like to correct your data?
Well, that's the thing is exactly. It's like,
Right.
to provide data to people who, are
Maybe you should send out a Google
confidential.
Doc survey internally, and people can anonymously.
Well, no, that's the
give
problem
you
is like
feedback.
and the other problem is like you look at Glassdoor or whatever, like you literally, there's like 1,000, I've had 1,000 employees, like the
Everyone
100
has
I
an axe
fired.
to grind, right?
Everybody has an axe to grind, right? In this case, it's not people who I would say have an axe to grind. It's people who are very successful and just didn't want to stay. But it's so complicated what you guys do as journalists. Because I do
I'm just figuring it out. I don't even know what I'm
I do all these. I used to be a journalist. I do random acts of journalism now, but I'm so conflicted. It's just.
I like that drive-by journalism.
I know. Oh, by the way, I want to say I have a total horse in the race for the IPO thing, so I feel kind of weird answering that question.
Oh, you do?
Yeah, because I was a Twilio employee, and they've been rumored to IPO.
Oh, great. Well, I hope that works out for you.
I don't know what's
By the way,
happen.
I was checking Mattermark's data, and they have the highest Mattermark score. I was just checking it right now.
This is not
Mattermark's
true.
very objective.
It's broken the Mattermark scale.
I actually love watching them on Mattermark, though. It's a fascinating thing because when you know things about how a company works and you see it sometimes line up and other times not, I have empathy for that too, and I do care a lot.
You're doing triangulation. You know what? I had a technique when I was doing my own venture database back in the day, which was we would estimate the valuations.
Oh, I'm so scared of this. Tell me more.
And we would estimate the valuation, and we would put estimated valuation based on other people in the category, just like Zillow would, people houses around it, and boy, did people get tilted. And I said, so I tell them, like, give us the valuation, we'll change it. And they're like, we're not putting our valuation out there.
But it's so hard. Like there was a big journal story about how mutual funds can't figure out how to value private companies. And they used Uber as an example and said, because Fidelity marks it here, Fidelity says it's worth, I'm making up the numbers, Fidelity says their shares are worth $5 a share, BlackRock says $6 a share, and T. Rowe says $7 a share. So they don't know what they're doing. And it's like, no. They might have all raised in the same round, but they all have different terms. T. Rowe might have a 4% dividend yield that no one else got. BlackRock, and BlackRock might have a liquidation preference, and somebody else might have a ratchet, which means if they all sold a share today, buyers would value it differently.
Also,
and people don't understand the subtleties.
Are the public markets that much better at valuing shares? Like, Apple has gone, look at Netflix and Apple's fluctuation in share price in the last 5 years. Like, it's not like the public market gets it right either.
No, it's just that public markets are more liquid, so people can make better decisions because there's more price transparency, more information transparency. There is not asymmetry of information as much.
More emotional
and you have a chance to get in or out. So yes, you have behavioral finance to deal with, but you have a lot of
look how emotional
positives.
people are with things. Like they all just ran from Netflix when they started changing their model and were like, hey, we're going to do, and then Netflix, that was the beginning of the true Netflix story. That when people look back on Netflix, the history of Netflix will not be mailing DVDs, it will be producing original content.
Exactly.
But the public markets wouldn't know that because they were like, oh my God, it's changing.
The interesting thing I always wonder is in any price movement, how much of the decision making is happening by a human versus a machine? So like people are scared supposedly, but what if only 20% of all those Netflix trades were actually like human decisions and the rest was just machine decisions based on price
action? All those people are front running the market and doing all that high frequency trading. It's like you never know.
Yeah, that's
why like I base my investment on a very simple thesis. Like, do people love this product? And is the product growing? And is the management team awesome at what they do? Like that's really all you need to know as an investor.
And it's
do people love this product?
A lot of public market investors, they make their decisions in exactly the same way. They just factor in valuation, but other than that, they're looking at the exact same
People
thing.
love Netflix. The people who run Netflix are really good at what they do, and it's growing. Like, we're done. Right? People love Mattermark. Growing.
Yep. I wanted to have
People
all my
love
numbers
Twilio.
for you.
The management team is doing okay.
There's a little bit aggressive on Twitter.
A little aggressive.
A little
on
bit of a
Twitter.
loose cannon
You've mastered
CEO.
Twitter. You're good at Twitter. Very good. Okay, listen. Amazing episode. We could talk forever, but we all got to get back to work and give Tony Fadell a hard time. So thanks to our sponsors, Envision and GoToMeeting. I love both those products. Thank you. And thank you, WeWork, for hosting us here. And thank you, Danielle. And thank you, Katie. You can follow Danielle Morrill, Morrill. And you can follow KT Benner, KTBENNER, on the Twitter and in the New York Times. Thank you, Emmy Award-winning producer Jackie. And we'll see you all next time. Bye-bye.